All right, in our financial planning series, we cover many important topics. But today, we're going to be talking about a very significant and often misunderstood retirement expense, and that's Medicare premiums. Most people know about Medicare, but very few truly understand that their income, yes, their income, can drastically change costs. All right, let's take a look, a quick review of the main parts of Medicare and their cost structure, focusing in on the premiums. Part A, or hospital insurance. This is usually free for most people because you or your spouse paid Medicare taxes while working for at least 10 years. Then we have Part B, and this is the part that we're going to be covering mostly. And this part covers doctor visits, outpatient care. It has a monthly premium, and this is the focus of our lesson. Then we have Part D, which is prescription drug coverage. This also comes with a monthly premium that varies based on your insurance plan and your income. The key takeaway here is that your income directly impacts the premiums for Part B and D. If you want to control your Medicare costs in retirement, you must pay attention to your income structure. Here is an important concept that catches many retirees completely off guard, and that's the 2 year look back. Medicare does not look at your current income to set your premiums. They use a 2 year delay. And the reason for that is they need to wait until you file your income tax for the previous year in order for them to see what your actual AGI or MAGI is. So Medicare does not look at your current income to set the premiums. They use, as we said, a 2 year delay. This means that a 2025 premium, and this is when this video is being made in December 2025, is actually based on your modified adjusted gross income from your 2023 tax return that you filed a couple years ago. Think about that for a moment. The financial decisions that you make today, like selling a large stock holding or doing a Roth conversions, will not affect your Medicare premium until 2 years from now. This delay is why being proactive, planning for long-term tax and retirement is essential to avoid costly surprises. And just so we're clear what modified adjusted gross income or MAGI adds back to your regular AGI, adjusted gross income, they add back your tax exempt interest from like municipal bonds or saving bonds. So this 2 year look back is what brings us to a financial threat to high income retirees. And that's IRMAA, income related monthly adjustment amount. And this table here, this chart is for 2025. I will also show 2026, how it changes over time. Think of it as a mandatory high income surcharge or a tax that is added to your standard premiums for both Medicare Part B and Part D. IRMAA is a real financial threat because it acts like a tax cliff, not like a regular tax bracket. You could be just $1 over an income threshold and be forced to pay the full amount of the additional surcharge for the entire year. And if your filing has a joint account, like spouse, you both will have to pay that amount. This single dollar of extra income can easily cost you hundreds or even thousands of dollars in extra premium. That's why we need to know exactly where these cliffs are. Now, this chart is the heart of this lesson. It shows you the 2025 IRMAA tiers, which are based on your 2023 modified adjusted gross income. So let's look at the first row. You can see if you're filing single, if you're under $106,000, you will pay $185 for Part B, and your premium will be zero based on your insurance. And if you file on joint, it will be $212 or less. Now, if you go $1 over, you can see you now jump into a different tier. They're going to take the basic, which is $185, and they're going to add the IRMAA surcharge. In this tier, it's $74, and the premium is for Part D is $1370. So if you add these two together, you're now going to be paying $259 per month. And it goes on and on. As you can see, as you get higher in income, depending if you're filing individual or joint, you can see now the IRMAA surcharge is $185. You add these two together, or surcharge $295. So you can see very quickly this could go up. So make sure that you notice the income limits for a married couple and versus filing individual. But also I want you to know that these numbers do get adjusted for inflation. And in the next slide, we will talk about the IRMAA surcharges for 2026. Okay, let's look at IRMAA for 2026. You can see for a single, I guess the cutoff of the income has increased lately. It's now 109, where in 2025 it was 106. And for filed jointly, it was 212. Now it's 218. But also the premium has gone up. In 2025, it was not only, but 185. Now it's 202 and some change. So you can see these cliffs have changed and have adjusted. And you can see depending on your income, your surcharges can be significant. And remember, these are monthly surcharges. And as we mentioned earlier, that we're now paying $202.90, where in 2025 it was $185. So you need to make sure we understand where these cliffs are. So if you are expecting a large income or doing Roth conversions, you need to be aware of this. Now, there are some links in our lesson outline screen that actually give you some information, and we'll talk about that in our next video. All right, I guess the good news is that because you know about the 2-year look back rule and the IRMAA cliffs that are out there, you can plan to avoid them. And this is where some proactive planning can be important. For an example, managing your capital gains. A large one-time spike in income from selling appreciated assets or completing a large conversion in a single year can easily push you into the higher IRMAA bracket 2 years later. You need to spread these transitions out over multiple years to smooth your income. You can also do, if you're over 70 and a half, qualified charitable distributions, or QCDs. It's a direct transfer from your IRA to a qualified charity. This money is excluded from your AGI, adjusted gross income. Therefore, it lowers your income. This is an effective tool to reduce your MAGI and potentially avoid IRMAA. QCDs can count as your RMDs. So Make sure, also, here's another tip. You could lose, if you have some total net capital losses, you can deduct them up to $3,000 from ordinary income. Your stock losses will first go against stock gains, but if you don't have any stock gains, then it can go against your ordinary income up to $3,000. So it's important to strategically time your income sources. Coordinate your income from RMDs, pensions, and taxable accounts. By carefully calculating and managing the taxable income you take out each year, you can stay below the IRMAA cliffs that you need to pick out which one you want to stay below. You can also use strategies like delaying your Social Security or converting funds to Roth account during your lower income years. All right, so this is where all the pieces of our course start coming together and start to fit together. So we need to do what is like some smart planning, which we covered in our earlier lessons. Is not just about lowering your current tax bill, it's also strategically lowering your MAGI to avoid thousands of dollars in annual Medicare surcharges. And then again, this is mostly if you're in the high income bracket. You're over $109,000 a year or over $222,000 a year. This is where you really need to pay attention to this strategic planning. Please remember that all these premium amounts, including IRMAA threshold, may be adjusted for inflation each year, so it does change. For example, the Medicare Part B deduction is $283 a year, meaning that beneficiaries pay this amount out of pocket before original Medicare starts covering their expenses. It used to be $257 in 2025. In 2026 is $283. What's it going to be in 2027 or 2028 or higher? It's going to obviously increase. In our next slide, we're going to be looking at projected 2026 premiums that you will need to pay in 2028. I have a spreadsheet that I put together that helps me calculate these things, and it might help you. It's kind of in a draft format, but maybe you could adjust it if you want to meet your particular needs. So let me just give a quick overview in the next slide. Okay, this is sort of a spreadsheet. I have it in Google Sheets, and you could put down the years that you're trying to work out. But here I use the tax rate for 2026. You can see the tax brackets for these years. Now, when you worry about taxes, if you go over your taxes a tiny bit, it's not a big deal. It's not a cliff. You just pay additional taxes on the amount you go over. But with Medicare Part B and Part D for IRMAA, $1 over is the cliff, and you're now in that next tier. And that's what I'm trying to calculate here. So I put this in, and you get, I have tax efficiency, and your Part B costs and your Part D costs in total. I would do a whole separate video just on this spreadsheet. So I just want to let you know it's there. You can view it, use it or not, whatever, it's good for you. In summary, this is your immediate action plan based on what we learned today. 1. Check your history. Pull out your 2024 or 2025 taxes, depending on what year it is, and find out what's your MAGI. The number determines your premium, your Medicare premium for 2026. Remember, MAGI is basically your AGI plus any tax exempt interest that you may have had, like mutual bonds and so on. Second, know your target. Use the chart on our previous slides or on the links that I provide in the lesson to identify the IRMAA cliff you want to need to stay under for the current year and for future years. 3. Plan ahead. Estimate your MAGI in future years and use resources, or if needed, a certified financial professional to help you determine your professional IRMAA surcharges, especially when you're anticipating a large financial event like the sale of a business, exercising stock options or having stock gains, or doing a large Roth conversion.